Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
All right, guys, we got 8 minutes, 7 minutes to the Federal Reserve release, where we find out that they're going to raise interest rates 25 basis points. And then we wait 30 minutes for the press conference. And this could be a madhouse. So we're already seeing here a really good indication of how crazy things are going to be is liquidity pulling early. So especially the 5 minutes before, you'll often see liquidity pull big time. But it's already a little sparse out there, putting out 800s instead of the 1500s that they were putting on earlier in the session. Now, interestingly enough, if we come back over here to the charts real quick, you can kind of see how the treasuries down at the bottom of your screen here all kind of fell off of the economic news that we got this morning. But since then, they have all recovered, although note that it's not, well, I guess on the 5-year end of the curve, they kind of recovered, but the flows aren't kind of really super in line with it, which kind of suggests to me this is just kind of mean reversion after the news. And it's not uncommon to see that sort of thing on a Federal Reserve Day. There's all sorts of wild stuff going on, and so you might see like a big piece of important news come out and then the market action after it not completely do what you'd think it should. Of course, all of the instruments move the way that they should, but for them to come back, I'm not sure. There has to be a good explanation for that, but we'll be paying attention to what they do here in 5 minutes, and then of course what they do after the press conference, which is where we're really expecting fireworks. Concerns, at least I'm concerned, that we could have a very aggressive, very hawkish Jerome Powell today. So let's see how that goes. Oh, somebody asked me a question down here. All right. So I guess until then, we just kind of wait. Hope you guys had a good morning. I'm feeling a lot better. I prefer not to take trades right after the Federal Reserve meeting unless I get like a really obvious, sign to do things. But I feel good enough that I could potentially take trades. I'm a little scared, but I'm a little scared of what we might see. Look at that 5K that just traded there at 28. Liquidity in the micro's not pulling yet. The equity market is doing some weird stuff here. It's not, you usually don't see movement like this just before the event. I'm a little the liquidity is definitely gone there in the treasury though. Let's clear these. 10 seconds. Here we go. Okay, so there's the 25 basis point hike. I had an opportunity. Oh. So let's wait. Okay, so they removed the phrase inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures, and changed that to inflation has eased somewhat but remains elevated. Also kind of just simplified some of the language around Ukraine to, I guess, suggest that it's not as big of a pressure anymore. In addition, the committee will continue reducing its holding of treasury securities and agency debt and agency mortgage-backed securities as described in previously announced plans. They also removed that public health as a factor in the committee's assessments. So did that liquidity come back in the micros? Interesting. So not anything too huge in the statement, to be honest with you, but the market's definitely moved on that. Nothing that I would say unusual for a Federal Reserve, even a Federal Reserve meeting where there's nothing in the statement. But they moved. So let's try and zoom in here on a couple of these. Need to make the bar width on these a little smaller. So look at the dollar there is all over the place. Boy, is it all over the place. And the treasuries kind of look like they're stuck in the liquidity hole here. There is a large order there at 22.5, kind of chasing them down. It looks like he hit down into them. Looks like he got patient and converted to a market order. S&P 500 still down overall. Well, pretty much everything is down across the board except for some currencies, and corn. Corn. I guess ZB is still up on the day, but that might not last long if it's not too much. Wouldn't have to drop very much for that to change. That's what I should say. See them coming back there. I really do find it amusing how furiously the market trades this when I can't parse out any real additional information in that statement. FOMC statement, minimal changes to the forward guidance, ongoing increases, language is retained. That's it. That's it. So there's a phrase that was in there last time, they're keeping it in there. Okay. Is that a big deal? AMD confirms a Ryzen 7000 X3D processor pricing. Well, check it. There sure has been a lot of volume traded at 23 and 23 half there are now. Like, it's not the point of control for the session, but they're getting into 60,000 contracts down there. That's quite. Is that that's not that low, is it? It is. It is. So, oh no. We traded here. This is where we were through like 10 o'clock and afterwards. So we had already spent a lot of time in that area. It's kind of what they're doing. D, I hope that Ninja Trader wasn't crashing on you. I haven't had any really serious problems with it lately. No, not today. Okay. I was those rows. The thing is when you have an indicator that does both looking at market orders and looking at level 2, it uses a lot of processing. Let's just say it is probably your most process intensive indicator. So last FOMC it did. Oh yeah, I do remember that. I remember you saying that. Good morning, Son Goku. My dog's name is Goku. No, I'm not like obsessed with that show or anything, but that's what the family voted on, so we went with Goku. I think it's one of those things where it's like the most advanced but still acceptable, and this is why like democracy always ends up like giving us the result that nobody wants. Yeah, was like, well, everybody was like, well, Goku's kind of cute, I guess I'd kind of be okay with it, but it was not the name that like anybody really wanted, so it's named Goku. Hey Meishan, welcome back. So me sitting here being like, oh, back to 3.47. If I think that the Federal Reserve is going to be hawkish, this wouldn't be too bad of a spot. But that ranging around the 23 area is not my favorite thing. I don't think so. I think that it's probably going to be hands off for me. I mean, we could trade the meeting and we could bet on rates increasing during the meeting, but that's always kind of a crapshoot. You never know what he's going to say. Now he's the most powerful. Wait, have they released like the new episodes yet? How do you know that? There's supposed to be a new season this year, isn't there? Confirmed to return in 2023. They're coming all the way back to the open now. They've almost completely retraced the move, which is also quite common during a Federal Reserve Day. So I don't know, but has main character buff. Because okay, so they haven't released the new season. Speculation. It is supposed to be this year, but they don't have a date yet. So right now he's not the most powerful being in the universe, right? Because Zeno is still the most powerful being in the universe, and the angels and the destroyers are supposedly more powerful than him. Although with his newfound powers, he may be able to challenge some of the gods of destruction. So the next season could be interesting. Could be interesting. I'm watching Mirror. What is that? I've never heard of that. I've been watching all sorts of weird stuff lately. Yesterday we watched The Rain Man from, with Tom Cruise. Old movie. It was a good movie. I remember watching it and I was like, well, let's watch it because my kid might be autistic. But I didn't really get a whole lot from it. It was just kind of funny. With Jeremy Reimer. Then I've also been watching this anime called Made in Abyss, which I don't know. So the premise of it is really cute drawn kids suffering horrific pain in a giant pit that has no bottom, sort of a thing. So I have to admit, there's a couple of things in the anime that I'm like, why did you? Okay. But has amazing world building. Animation is really, really cool. There's so many cool things about it, and the music in it, the music in it is like legendary tier. Good stuff. Good music in it. What time is the press conference? The press conference is always at the bottom of the hour following the initial release. So at 2:30 Eastern time, or 12:30 on the clock here. Yeah. Like the song that just came on, it is Legendary from Stream Beats with Harry Zeller. I was just watching his channel, and he's been working with these guys to make a plugin in OBS that allows you to multi-stream to a vertical format. So basically, they set it up so that I could stream on YouTube and to TikTok at the same time. So maybe I'm still dealing with an issue at work, but once I get that done with and after work, maybe I can mess with that. I don't think I should work. I really want to get working out again, but I really think I got an ear infection. I really think I got an ear infection. How would you like to trade? No, thank you. That sounds terrifying. Oh man. There's people that do it though. Crazy people, but there was some people trading in the micro treasuries here just, after that news, and You can see a couple of the orders that went through. Somebody bought, the people that bought up above 3.49 though, that's not good. Because I looked at it and I was like, well, the 3.49 is looking kind of tempting. But the way that it was pulling was kind of like, it said to me, okay, or like you're gonna get this hole, it might come back, so now's not the time. And then it just never really visited again. So I'm sure glad that I just, you know, just sat on it. Yeah, see Brannigan Barrett, I think I'm with Brannigan here. The statement was unchanged. Now tell the markets for how many hikes you expect to make policy sufficiently restrictive. By keeping in the ongoing, the Fed opens the door to an additional 25 basis points of hikes at the May meeting. Bonds not got the message yet, but it's coming, he thinks. I may. I'm seriously tempted to go long rates here. I do not like the inflow of buying I'm seeing in the 10-year. So cumulative delta is higher than it was before the news. So the overall net effect in ZN has been buying. That could be just profit taking, like somebody expected it to be bad and they said, oh, okay, that's good enough. I'll take it, and took their profits. Maybe. But either way, there's buying, so. But I think the play here would be, you know, it comes back to break even, and so you take it. See, now that's it's a few ticks down, but at very low volume. Do you make a lot doing this? I'd say it's mostly for fun. The amounts that you know, if I do take a trade, the amounts that I'm risking are super small. Like we're talking about like $10 at a time. So, and I don't sell courses, nor do I sell mentoring, but you can get on the stream and ask me questions anytime. I'm very available in that respect. Stream has been doing really well lately, but we're still to the point where if you message me, you'll get a reply. So. Well, who knows? Maybe today is the day that I YOLO in on something, and no, I don't think so. I'm still a little weary about what I'm seeing. The movement in the dollar, I'd say, is really interesting. Yeah. But I think the big trade is still kind of to come. Need to remember to pull up the stream when we're getting close. So you know what? Earlier today I was like, oh, let's do a little bit of writing on our PDF here. And you guys remember when the news is coming. None of you reminded me. So I'm not trusting you this time. I'm watching that clock like a hawk. And come 12:30, we'll pull Powell up. And if I had been able to catch 3.465, I don't know if I would have actually gotten fills there. I don't really see any volume having traded it last time it touched, but that would have been a good play. Don't you think? For 10 bucks. So to be 10 bucks in and it go in my direction, that's not bad. S&P 500 is still just churning. Look at this crazy double distribution we've got at 4070 and 4080. You don't see that every day. Uptick. Noticing some changes in the yield curve. It looks like the 2 and 10 and the 30 and 5 are both flattening somewhat, but the 10 and the 30, the knob spread, it's unclear. No, I have the right ratio over there. I'm not sure. Not big brain enough to have to understand this, but why do, when the financial conditions loosening conversation came up, did people start saying TGA drawdown is offsetting Fed hikes? Sorry, what does TGA stand for? Are you talking about the just the Treasury General account? I don't know. So I think the thing is right now is that there's just a number of factors out there in the Treasury market kind of suggesting that demand for treasuries is going to be a little bit higher than it usually is, right? So the bonds have had a really good start to the year. But I also do see people kind of trying to I think that people will say things, they're putting it out in the public because that's the direction that they want to move the market, I think that happens a lot on the internet. So you could be careful with that, right? And like I said, where the market is, I think that they're very vulnerable right now. I think that this market is very vulnerable. Powell says the right thing. The S&P 500 could take a total nosedive. I mean, just being at 4090 here right now is, I wouldn't, you asked me a month ago, I wouldn't have said we'd be above 41, close to 4100. I don't know how the general account drawdown is offsetting hikes. I hadn't heard that one. Actually, I vaguely remember a story about that, and I don't think I read it. So the one that I've been saying is that there are going to be a lot of pension funds that are going to come and buy treasuries because they're overfunded. So they're overfunded by like $1 trillion, right? So they're going to come in and buy some treasuries that could offset rate hikes to some extent, right? That's all you've been reading on Twitter for the last 2 weeks? I don't know. Twitter overall isn't terribly reliable, is it? No, I haven't read that one. No, but there was a story about this on Zero Hedge. There was a story about this on Zero Hedge. Yep. That's what I'm talking about. The Bloomberg piece about $1 trillion in overfunding pensions. So there's only one problem with that story. They've been overfunded for like several months now. So probably going all the way back. How far? Where do I have my? Probably going all the way back to when this started at the beginning of the year. That's probably been a factor going all the way back to the beginning of the year. So who knows how much more of that flow we're going to see through for the rest of the year. But like, it's not gonna save you if Powell comes out and is hawkish, right? It's gonna be, you know, I think that what you do here, I think that what you do is you let the Federal Reserve smack down the market again. And then you pick up the pieces afterwards. And when you pick up the pieces afterwards, you're going to have to be in it for the long haul, because it's going to be something where, like, we're going to slowly creep higher over the course of the whole year. You know, it's not going to be a quick swing, I don't think. Yeah, you know, there is definitely a propensity for the people online to kind of push like the counter narrative, right? Well, I wouldn't even say it's the counter narrative. I let's call it the cynical narrative. Do you know what I mean by the cynical narrative? Like it's always the narrative that's going to be something awful is going to happen. It's not gonna go well. I'm warning you guys. It's the doomsayers. Right? The doomsayers always get the most attention. What about the Fed trade desk using the 2024 SOFR contracts as a substitute for repo margins? All I know is that all of my flow reports say buying. And I don't 100% understand all of those individual flows. But, you know, like I said, a lot of this flow's already kind of come through. We're talking about super passive flows. And right now, the thing that's going to matter is what Jerome Powell says, right? So if he causes the market to sell off super hard, then that could give us an opportunity. But there's a lot more involved in it than that, isn't there? That's funny that people keep saying they love the music, because I'm just using the same street beats music that like everybody uses on their streams. Isn't this like you don't hear this on every stream that you visit? Maybe you guys, probably most of you guys don't watch live streams very often. It's just stream beats. It's just stream beats. So coming back again. Oh, actually interesting. So the treasury is about where it was, or sorry, the 10-year is about where it was, but the 30-year has had a little bit more of a falling down. So they're about a basis point higher in yield at the moment. I'm getting a move the other way here in the treasury though. I need to come up with a different nickname for the 10-year, because it just sounds like I'm saying tenure. We need to come up with a good nickname for the ZN. Yeah, you don't watch any. Yeah. Figures. Well, I appreciate you coming in here, becoming a new member. We have a really dedicated community. These guys are here every day, so get comfortable, man, because we have fun. And we're gonna have fun here when Powell starts speaking. What was it called in the pits? Did they have a nickname for it? Dimes? Yeah, let's call it that. So then what did they call the other ones? Dimes, 30s, and 5s? That's what I'm going to do. I'm going to call it dimes. And let's see how good of a job I do. That one might be hard to remember at first. To remember to use. Wait, so are shorts like 2s? 2s, 5s, 10s, and 30s? No, it's 12:30 right now. Going to close down the financial juice stream here. ZT, ZFC, and ZB. Shorts, mids, dimes, and bonds. So would they talk about spreads using the same terminology too? Like dimes and bonds spread? I'd think they would just call that the knob, right? Yeah, knob is literally notes on bonds. Okay, here we go. So I'll put this over here. Who's taking a picture? Okay, the reason the ongoing increases language is so critical in this statement is that increases is plural, 2 or more. You can't have one increases.
My colleagues and I understand the hardship that high inflation is causing, and we're strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments.
Oh, he'll have more to say, huh?
Significantly last year, with real GDP rising at a below.
That seems a little ominous.
Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also.
There's a small flurry of activity there, and now it's paused.
Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000.
Jerome P. says shit is bad and stop putting words in it. Let's see. That sure would be something if that's what he did.
Over the course of the past year, and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers. and the labor force participation rate has changed little from a year ago. Inflation remains well above
Starting to see a lot of volume in the dimes.
over the 12 months ending in December.
It looks like it's to the downside.
Rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path.
So that comment right there is probably very
Despite elevated
critical.
inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy
Ongoing increases.
restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in
When he said that, though, market was not
economy, particularly
caring.
housing. It will take time, however, for the full effects of monetary restrictions.
I bet you that one of the
inflation.
one of the news reporters are going to ask him that like
And the
first
lags
thing.
with which monetary policy affects
Try and confirm that. So does that mean that we'll probably be doing one in May?
raise interest rates by 25 basis points today, continuing the
And then it'll be like, well, it's just, it's not meant to tell you how many there are actually coming, but could mean more than one.
progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data,
Continue to make decisions meeting by meeting.
economic activity, and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
Looks like the most uneventful FOMC. Well, the market has reacted to his opening statement a lot less than they have in the past, haven't they? And if anything, maybe some of them are saying he didn't say anything too bad in his opening statement and are taking it as bullish.
Bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%.
There you go.
And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate.
Ongoing hikes.
Affect financial conditions, not just our policy.
See, he's.
And we will take into account overall financial conditions along with many.
You notice the intonation in his voice there. He's suggesting that that language is important.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices.
It looks like the market wants to buy it at the moment, though.
Consumer spending.
Too many shorts, maybe.
The unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is...
I don't know what caused that to say that.
You see inflation now coming down because supply chains have been fixed, demand is...
Yeah, I don't know where that came from. I heard that on my computer.
Shortages have been abated. So
that slow computer bit, I don't know where that came from.
In the housing services sector, we expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called
S&P 500 is rallying at the moment.
We don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But, you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings.
I feel so fucking stupid right now, guys.
Cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings. I
feel like that
looking for work. So
he's not saying anything significant, and the market is unwinding here against me, and I shouldn't be in a position.
If you look across the rest of the labor market, you still see very high payroll job creation.
I took a bad loss that I shouldn't have even been in a position.
Quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
And I waited way too long seeing that flow come in against me.
Since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward, or does ongoing now mean more than 2 rate rises now?
So
I told you somebody to ask.
December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think, we're going to be looking carefully at the incoming data between now and the March meeting and then the May.
Well, now it's really running, dude. Look at that.
Don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing.
Wow,
down
that's
right now.
really
If
a
we come
little
to the
bit
view that we need to
excessive,
write
in
down,
fact.
to move rates up beyond what we said in December, we would certainly.
Yeah, somebody must be unwinding here, man.
In the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector. And they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Like he's saying the thing, but the market is not listening.
Connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect
somebody's being super aggressive here and trying to push it
for several months, but will then come down
right there at 11.5,
assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down. This is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same. And, we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent, we'll see more persistent inflation in that sector, which will take longer to get down.
Well, I don't really feel like the market makers did pull orders, so NASDAQ killer.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the
range stayed constricted until
rates and see that real rates are now
we
positive.
are kind of getting some signs of like moderation.
Measures are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments?
So even though you're seeing some pullbacks, you're not necessarily seeing outright selling
you're really asking about, you're asking about prioritization in effect.
I don't know if it was that the market wanted to buy regardless of what he said. I think that it was kind of more that the hawks, the people that were short, let's say, and both treasuries and equities, wanted him to say something or wanted him to be more forceful than he was. And because it wasn't more forceful, it's become more dovish than expected.
I'm just going to leave it at that.
And thus the market is doing what it's doing. See, like this is not.
I'm just going to leave it at that. This is a matter that's to be resolved between it's really Congress's job to raise the debt ceiling. And I gather there are discussions happening, but
and now you're probably seeing stops and all that sort of stuff, second order effects. So I'm being stupid me trying to reverse that was dumb as fuck. Right.
Gina Smilek from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So, the committee, obviously, did not see this as a time to pause. We judged that the appropriate, thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates.
Well, we're at, okay, so like if we come in, you look at a volume
on the
profile,
deciding right now.
we're not to monthly highs from January yet, but things are getting awfully easy here.
PCE inflation rate in 2023 at 3.1%.
Seeing yields below 3.4 is a little striking to me.
Without going to your 5.1%.
And they don't seem to be backing off either.
For this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that that unemployment will probably rise a bit from here, but I still think, I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's
Switch the sound of the trailing. What are you talking about?
The setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior,
So look at that, some selling into 15 and an iceberg below it. So their buyers are still there. It does kind of look like they might be. I'm starting to see that curve
on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question. No one really knows. I think it's because this is not like the other business cycles.
Okay, him just saying that maybe we could get there without 5%, it being possible, that was very dovish.
That it will take more slowing.
That's triggering some buying here. Look at that.
Inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome.
So there's an offer there at 15.5. They're having trouble getting through.
Say it's not the most likely outcome, but
they hit that. They hit that hard.
There's a chance of it.
It didn't bust, but they hit it hard.
Michael. Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask with...
Yeah, that must have been, that might have been the close and the pit close.
With the progress against inflation, there's still a lot of talk about...
Well, I mean, that was the pit close, but that might have been why we saw that rush of orders.
23, and the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of
seeing some selling in the 30-year
last year, and also
yield curve is steepening really hard. So that's probably why you're seeing the selling in the 30-year.
I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year.
I'd say you're still getting pretty healthy volume here in dimes, despite the pit close of the options pit.
Is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money.
It looks like the yield curve is moderating a little bit here. It's a little bit of a flattener these last few ticks.
Also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic.
Do something, entertain. Now is probably not the time for entertainment. Now's the time to focus.
Support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Wow.
Thank you.
Okay.
Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So
metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's.
Now look at the S&P, man.
Where they were before the
4130.
Before the
and
so.
I'm rearing to bust highs again here.
But as the accumulated.
Look at that level break setup right there, 4130.
In our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. We're not. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go.
The SPOOs are not stopping, man.
And it's most welcome to be able to say that we are now in disinflation, but
there's got to be.
We just see that it has to spread through the economy.
Somebody's must be getting royally screwed right now, man.
Federal funds rate remaining at this elevated level.
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with
Look at that, 10K absorbed at 4135.
If inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
They may have finally filled it.
With The Economist. May I ask a
question
with the language of ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely.
I think that the market was reacting to the question.
Will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts. Different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession. and we have inflation moving down, into the somewhere in the mid threes or maybe lower than that this year. We'll update that in March, but that's what we thought in December.
We're definitely stuck in I think that we've got a liquidity hole going on here because we've seen quite a bit of volume come through both sides quite aggressively in the Treasury, and it's just like not moving it.
Given our outlook, I don't see us cutting rates.
Are there any bears left? I think that they're probably,
as I mentioned just now, if we do see inflation coming.
I think that the bears could be unwinding all the way into the close in ES. I think that if I had a long in ES, I'd be trying to hold it to the close.
One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing.
I'm still kind of mad at myself. Like I mean, I think I needed to do this because
no longer see the pandemic
I need to get myself into the more flexible mode, be a little bit quicker on my feet in a situation like that. So it took me way too long to flip around and be like, well, I guess he's not going to do the thing that we want.
It's no longer playing an important role in our economy. And, we kept that statement in there for quite a while. And I think we
see how like the buys come in and then it rests back to 115.14.
People are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem.
It's too late.
That means that effectively, in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't let allow.
Okay, some volume back and forth there at 12.5.
The longer we're at this, and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are. We pick that up in conversations, and I've seen some data too that show people are, gradually they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses that essentially. We believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well.
There's another bid iceberg there, 13.5
so
dimes.
It's and I think that's very reassuring. I think the markets.
S&P 500, I think, finally filled that huge bid that was chasing it all the way up. So you might get a pause or a reversal there.
Of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting
The
to now.
journalists are giving him every chance to be hawkish, and he's passing.
It's important that the markets do
Keeps
reflect
passing.
the tightening that we're putting in place.
Right.
As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Last question, huh?
Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact
That's easy. No. The answer is no.
faster quantitative tightening could bring us closer faster to that drop-dead debt ceiling deadline. Could it play?
What happened is here's the new guy, and they gave him a chance to ask a question. He asked a dumb question.
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will.
Whoa! Did you see that 8K there? Holy
Raise
shnikes!
the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that
There's a 7,500 lot stacked and then pulled at 12.
We'll monitor money market conditions carefully. As the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there
Spoofy doofy
repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it.
I don't want to talk over him too much.
Thank you very
here.
much.
Okay, so something that happens, the way that it works on a professional DOM, there's different ways to do it. Like you can set a hotkey to be like, okay, you click and now it's an iceberg order, right? But what often will happen is you put it on there and then you right click on the order and you say, oh, this is a refreshing order. And then you click OK. So what you'll see often is an order will get placed on there, and like almost as quickly as it was put on there, it updates and pulls. And it's not reacting to the market or anything like that. So when I see behavior like that, where it stacks and almost immediately pulls, and it seems to be completely isolated and not related to anything else in the market that's going on, that to me is a sign that like they're saying, this is where I want to get filled at. Come and get me. I would not look at that as a spoof. Well, we'll see. We'll see if, they haven't really hit 12 yet, but let's see if it takes a lot of orders to get through there, then there's your answer, right? There's like a 10K iceberg at 12. But right now it doesn't look like there's the sellers to sell into it. He might have to come up. He's trying to negotiate and he's not. It's not going so well for him yet. Well, the S&P is turning around here. And it kind of looks like the dollar as well is found its spot. And the treasuries, there's a little, the micro dimes had a little bit of volume right there. Yeah, that buying spree in the E-minis was insane. I don't think I've ever seen one like that, except for into the close yesterday. Like going into the closes on the end of the month, I guess I've seen stuff like that. But it's just like this huge iceberg that's just sitting on the inside bid the whole time and is just absorbing everything that goes into it all the way up. And it was doing that for like 30 points or something. It's nuts. See, so Nick Timoros, he says, my takeaways from Powell's press conference, we are talking about a couple more rate increases. We're going to be cautious about declaring victory and sending signals we think the game is won. Certainly is not appropriate up here. So again, like what I'm hearing is, you know, the Federal Reserve is staying the course, which I think is hawkish. I think that means that they're likely to continue to try increasing rates maybe several times, and that they're not seeing anything that suggests to them yet that there's some disinflationary wave coming that some people are seeing, right? So it is what was in my expectations, but the sentiment around it was not. And I think that the market overall was expecting a hawkish Fed. I think that I was talking it up. Many people were talking it up that today could be a bad day, and it did not turn out that way. He was, I mean, and they gave him several opportunities to smack the market down if he really wanted to, and he kind of passed on it, right? He kind of was, the way that he approached things was really like avoiding saying anything too important. You know what I mean? Well, Jake Sherman is you know, tweeting about that last reporter. I'm sorry, bro. You're listening here. I thought that was a dumb question. The Federal Reserve has been asked in the press conference many times about, you know, do you consider the amount of the debt in your decisions? Do you factor in these political considerations? The answer has always been that those aren't our problems, right? So I feel like he wasted a question, you know, and you could tell that Powell was a little taken back by it. It was like, wow, I didn't expect such a dumb question at the end. You know, I think he blew it. But you know what? You'll probably get another chance, mister. So, with avoiding any bias and 2 more hikes being certain. So number one, I don't know if 2 more hikes is certain. I think that 2 more hikes would be my base case, but I'm not going to call it certain yet. Okay, there was a decent amount of volume both sides there, 13.5 and 14. So we're getting icebergs on both sides of this all over the place. Which again, looks to me like we are stuck in a liquidity hole. My depth tape size filter is set to 1,000, so I'm only seeing stacking. I'm only getting alerts for stacks and pulls of more than 1,000 contracts. 7,000 is a lot. To see 7,000 stacked and pulled at 12, that's a lot. Yeah. Even if we were back in like the normal times of high liquidity, that would be a lot, right? For sure. Like 8,000 was like a large bidder offer overall. So to see 8,000 total stack and pull is a little zany. Yeah. Yeah, I think that I may have made some bad decisions here today because, as we've mentioned many times today, I'm not feeling super well today. And, you know, I don't think that the things that got me into those first 2 trades were very good. But I really should have been more flexible, and I'm not sure why. I think that I've just gotten in too much of a mode of being really stubborn, you know, and really trying to hold out as long as I can. I really should have been more flexible. I could have turned around, and I can remember specifically, it's like burned into my mind now. There was a point where I was like down 30 and I was like, okay, I should get out. And then it pushed another 20 real quick. And that's when I was like, shit. I was really upset with myself for not acting faster. Because if I had acted then and even tried to go to reverse, I probably could have reversed the losses. And now, probably no matter what happens, I'm taking a big licking today, which was really unnecessary. It was really unnecessary in the long run. So I don't know what to do with that. That's super frustrating. We may be getting to the time where the market may be recovered enough that we could have another move up though. So let's see. The S&P 500 is looking not too shabby. They're still kind of holding where that last. So there was like the breakout above 4120. Let's call it 4130, right? Now they're coming right back to 4130 and holding it really well. Also seeing the yield curve steepen considerably. Like, at this rate, we might see the 2-year below 4%, which wouldn't be. Yeah, seeing the 2-year below 4% is like, okay, cool. It's been awfully high for a while, but seeing dimes below 3.4, that's not right, man. That's not right. I continue to see really aggressive takes. You know, like right there at 1800 contracts take it to push it bid very quickly. $401k to the moon. Okay, let's see with Brannigan. Where to begin with the Fed? I'm quite shocked, stunned. Powell was very out of character today. In summary, the word I would not say that it was very out of character. In summary, the word disinflation was thrown around lavishly. He didn't rule cuts if inflation comes down quicker and hinted that in the minutes we are likely to hear about a pause coming in as soon as the March meeting. Financial conditions have done nothing since last meeting, and Powell's things soft landing is his base case. I can't remember a time when the Fed chair was that dovish. Markets have responded accordingly. Dollar in trouble. I favor two trades now: long the Euro USD or long gold. How is, oh wow, gold is taking off. Wow, 1961 in gold. Well, that's only just a hop and a skip away from 2000 in gold, isn't it? Wow. Okay, and here is finally coming back up to the highs and breaching the highs in the treasuries. So at least I got that right. The whole wait 45 minutes thing sure is useful. Still feel anxious, but oh well. Oh well, it's not the end of the world. Actually, it's really just a retracement of our losses from earlier, of our gains earlier in the week, so we're fine. We're fine on that front. It kind of sucks because I guess if I had done it right, I probably could have made $100 long today, huh? I went through that a few days over the last week and a half. Yeah. I mean, it's not unusual for me to come into a big meeting like this and even if I'm right about what's going to happen, end up losing more than I want, right? Because, it's just volatility, right? But in that situation, I really could have limited my loss a lot more than I did, and I'm just really mad that I didn't act fast enough. I don't know what I need to do to get myself in the mode, but I kind of consider this one. Well, I think it was a double-sided thing. That this time, number one, like my planned case was wrong. Okay, I wasn't like married to it, but I was willing to be like, okay, the market is reacting because like he's not really saying anything, but there's still a chance he says something hawkish, so I want to still be positioned for it. I think that was a bad way to play it. So I was wrong on the overall play, but then my psychology was wrong too. I held on to it for too long. So the first one, that's going to happen sometimes. That second one, we gotta do something about, right? We can do something about it. I'm not quite sure what, but we should. I guess Rick Harrison was not here with us. Hello, gamblers. We did. I did gamble a little bit today. It's true. I did gamble a little bit today. I'm a little excited to see where my 401k is at now, though. Or my regular account. Let's pull it up. I'm actually a little nervous to pull it up because like today's gonna be a good day, but I'm probably not getting as much as probably would like. 30 years still lagging considerably, by the way. Yeah, how am I only... Oh, okay, yeah, I've made 3% on silver today. 3% on silver. Ooh, doing good. 2% on Sumo Logic. If I could see Sumo Logic above 13 to 15, that'd be awesome. So what do you think? I'll move this month. So if we go back to what we thought was our scenario before. So the scenario I wanted to see happen was the Federal Reserve comes in as a little bit hawkish and the market takes a huge steaming dump. And then after that, and part of the reason why I was looking forward to seeing that was because there was a number of passive flows suggesting that some allocation into bonds could happen. Okay. So now that we didn't get the big ugly sell, where does that kind of put us? Well, I think that puts you in a position where the passive flows still need to buy, and they're under like a lot of pressure to do it too now too, because the earlier you do it, the better of a pricing maybe you get, and so forth. So could we see a move up this month, at least in the treasuries? Yeah, I think that this could be overall bullish for treasuries for the month, but big but. This is just like the one move immediately after the Federal Reserve, right? The biggest mistake, it's not the biggest mistake, but one of the most common mistakes that we will see over and over and over again in regards to retail traders and Federal Reserve meetings is that they think that the first move that happens after the Federal Reserve is like the correct move and tells you everything, right? So this goes back to the fact that most retail traders are just following other people and believe that the market is informationally efficient. So if the market rises after Jerome Powell's press conference, that must mean that what Jerome Powell said was positive, right? But the reality is that it was dovish in tone, but in terms of the actual raw information that we got, it was not much of a change from anything that they've said previously, right? So there's a good chance that tomorrow we see a lot of this retrace, or that, you know, we see counterflows and that they have to continue fighting this out a little bit. Well, as for me, the most I ever got out of this was 15 ticks favorable, and that is not the best for the amount of volume that we're seeing come through and everything else that's been involved here. The 30-year is lagging really hard, though. That's kind of what's going on. So you see dimes move up 3 ticks there, and the 30-year didn't move budge at all. There should be a correction. Well, I wouldn't. So you're saying, when you say that, that kind of suggests to me some sort of a technical analysis pattern that, well, it has to retest because that's the pattern. It's not that. It's that what this probably did was it probably brought forward a lot of demand, right? Probably brought forward a little bit of demand. And so you might see tomorrow demand be a little bit soft. That doesn't mean that it has to come back necessarily. So the other thing that we've got to consider is that tomorrow we've got jobless claims, and then we've got a non-farms jobs report on Friday immediately after this, right? So we're going to continue to probably see volatility here. We get another really strong jobs report, that could be that could really throw a wrench in what the market's doing. Thank you, NASDAQ killer. I appreciate it. It's not my best day, but I'll get over it. I'll get over it. By the way, a lot of newer people in the stream today. I appreciate it. Make sure you click that subscribe button and the bell icon. That makes it a lot easier to find the stream when we go live every morning starting at 8:30 Eastern time, here every day. And then, of course, when I put out new videos, I've only been doing them about once a month, but when I put out that video, you don't want to miss it. So it can't take off from here if not a retest, at least to chop till buyers come in heavy. Yeah, and as you say that, it busts new highs. The further on this goes, so you can see in the treasury they're having a really hard time with the liquidity, and that's kind of creating liquidity holes and making it a little bit more difficult to move up. But the S&P 500, the bid over there is so incredibly strong. It's just like, it's not stopping, man. This looks like somebody is covering or something insane is happening there, and they're gonna keep chasing it all the way into the close. I don't know if you're gonna like my channel then, Hal, because basically all I do is rip on TA all day, including the technical analysis of order flow. There's got to be somebody that was short and they're covering, man. It's got to be. I've never seen the spoos so desperate to chasing it so hard. It's like every downtick, they're just absorbing as many contracts as they can on it. It really is an insane move. Oh man, look at the ZB came all the way down and now I'm down 8 ticks. What the hell? This sure is frustrating, man. You know what? The dimes are kind of staying up here, and the other two have actually kind of fell a lot further, so. Well, it's not too encouraging. for my position to really work out well now, I think that I would need to see a lot more buying in the 30-year than we've seen. I am against auction market theory, yes. Well, should I say it against? I mean, it was a useful theory. I'll give it that much. It was a useful theory, but ultimately, I think that we have better, more correct theories about the market than auction theory now. So it's not auction market theory is not bad, but we have better theories now. The whole liquidity hole that was shown in the Walrasian auction studies, I think is a better explanation for the behaviors that the auction theory is attempting to describe. The stock market is going to post in 100-point gain today. Is that what we're going to get? You know what's crazy though? I actually still have some stocks in my portfolio that are down on the day. So what's with this? Let me refresh here. Let me just get like the most up to date. No, it's not. Well, so I think most of the oh man. So, you know, one of the issues is that people will use different terms to mean different things, and you know, all of that sort of jazz, right? So to me, order flow is just the study and analysis of orders placed on the exchange. That's what order flow is. Now, order flow requires market depth in order to do so that you can categorize the market orders, and you want to analyze the limit orders as well. Okay, but that's order flow. Auction theory is kind of more this theory about that the market will find a place of balance, and then some major player will come in and test the range using range extension, right? So like I said, auction theory was a useful theory to try and explain behaviors that we saw in the market, but what we know about the stylized behavior of order flows now is, I think, a much better explanation for what's going on, and it kind of contradicts a few key points in auction theory. The most important one being that under auction market theory, they say, okay, so when it spends a lot of time at a price and there's a ton of volume has been traded in there, that is an indication of price acceptance. That represents value and price acceptance. And what we know about what actually causes these behaviors suggests that that's not the case at all. So what do we actually know about these behaviors? When you get a ton of market orders come through the market and they take out the liquidity in an area, liquidity providers are going to have less liquidity to be able to provide in that location. And so you can get into a situation where there's not very much liquidity here, but there's a lot of liquidity above us and there's a lot of liquidity underneath of us. And so the market just ends up getting stuck in that one area where there's low liquidity. Now, you could still see a lot of volume trade there, because what will happen is it will stay there for a long time and they'll just kind of trade it back and forth a little bit at a time. And you'll see it'll just trade a little bit, it'll move a tick up, and it'll trade a little bit and it'll tick down. But then over the course of 30, 40 minutes, that becomes the point of control, right? So what is that? Is that evidence of price acceptance? Doesn't really make sense. Why would you trade there if you thought that it was a good price? Doesn't make sense at all, right? So the reality is that the reason that that becomes like the balance point or the quote point of control is really a coincidence. It's really an accident that it just happened that a large trade happened in that location and kind of created this odd situation in the liquidity that makes it difficult for price to move up, right? Similarly, range extension isn't necessarily somebody trying to like bust through the range or anything like that. Range extension is just a large meta order coming in and executing, right? So why are these important things to note? Okay, because auction market theory in the end ends up being another attempt at applying technical analysis, which is to suggest that the market is informationally efficient and that the current prices that we're getting here and the movement and so forth that we see is a perfect reflection of the underlying information that is important for us to determine what prices are worth, right? When you understand that like that point of control is kind of a coincidence, right? That price doesn't hold the same kind of power over you, right? And people assign the point of control in particular all of this predictive power, and it doesn't have any such predictive power. In fact, when you actually look at the stats that these guys will commonly cite in relation to the point of control, what you're going to realize is that really they're just describing stylized behaviors of market volatility, right? We're likely to touch the previous day's point of control. Yes, because the previous day's point of control is going to be within the range for volatility. And then if we don't get the previous day's point of control, you're probably going to get a big move because you're getting one of those situations where volatility outperforms what they were expecting, right? So again, we can't just come in and look at the exchange generated information and make a read on what the fundamental situation is, right? And that's very, very important for the situation that we're facing right now, because you got traders trading and all that sort of stuff right now. So today the traders read what Powell said as dovish, okay? So that does mean that more likely that maybe we do need to move up, right? But it's not a guarantee. And there's been plenty of situations, including the last 2 or 3 FOMCs, where the very next day, the price movement was the exact opposite, right? So the key thing to take away is markets are not informationally efficient. That doesn't mean that you can't trade. I mean, if we were to say markets are not informationally efficient, that the extreme of that would be that it's all just random and nothing matters, right? It's not that. It's just that we can predict price better by predicting future orders, right? And yeah, we want to monitor the fundamental situation, but we're going to have to do that separately. Since prices don't tell us everything, we're going to have to monitor the fundamentals and we're going to have to monitor the price and the orders, all separate things, right? And look for situations where maybe those things are coming into confluence or realigning themselves correctly to give us a good trade. Yeah? I think I got a little carried away there now, but I think you guys got the point, yeah? Traders after some time just want objective rules to follow when they're trading. Well, yeah. I think that really is a lot of what it comes down to. Well, it's not that they want objective rules, it's that we want to see patterns, right? And the thing is that there are patterns in markets, it's just they're not predictive patterns, right? The patterns are results, not causes, right? Well, I tell you what, this pullback and move back to the highs looks awfully nice in the 5-year. On the 5-year, it sure makes it look like it's going to break out to the highs. But in the other instruments, it could just be consolidating range. right? So what do I mean by the patterns are the result? Well, if the majority of the volume that has to be executed, there are people out there that they absolutely have to do something, right? That's their job, and they've got to execute this order to get out of a position or whatever the deal is, right? So when you look at all of the volume that has to go through before the end of this session, right? If they're done, then what we should expect to see from prices consolidating range, right? That consolidating range doesn't necessarily predict that we're likely to move up or move down on the next move or anything like that. It just means that the flows have kind of died out, right? This song is a little nasty. Well, the E-mini has taken a break. So here in 30 minutes, for you guys that aren't familiar with watching the close, in 30 seconds here is going to be the cutoff for market on close orders. That is when all of your market on close orders have to go in, and then a report is released showing how much volume has to be executed and everything here, right? So that imbalance can tell us a lot about how the close is going to play out. We'll see. I would expect there to be a buy-side imbalance going into the close, but we'll see how big of an imbalance it is.
Currently sitting at 861 million to the sell side, just waiting for those final orders.
Right now, it's 861 million, which is relatively large, but
settling at
it's really into the billions when it's a really big deal.
the market on close imbalance for the NYSE, 853 million to sell.
Okay. Oh, it's actually 853 to sell. Okay. Well, that's not particularly encouraging for me. So I'll get out there. Only taking $5 off of that after being in there for over an hour. That sure sucks. Oh man, you know what? Going back to these other ones too. That was a loss. I was only in for 3 minutes. It never went in my favor. I don't know why I held on to those for so long. It's so dumb of me. I think that one of the big downsides to when I'm really being judicious and go long periods where I haven't taken any trades is you kind of get a little rusty. Yeah. But I took a loser today. I took it on the nose today. I really shouldn't have. I should have been waiting for things tomorrow and Friday. Maybe even tomorrow and Friday might not be the best opportunities for us. Well, let's just see how it plays out. Hopefully I feel better tomorrow. Well, they gave me $5. That was probably the best I could have expected because look, it's come right back to where it was. See, I should have known better, like, This big move right here, I think I did try taking a short somewhere up in here. I should have known. That was dumb. That was just me being straight up dumb. There was absolutely no reason within any of the rules or anything that I ever talk about here for me to have gone short there. I don't know, just me hoping that Powell was going to say that it was going to say what I wanted him to say. That was bad. It was a bad set. This is the perfect example of where we're talking about we've been doing really well. We have had a lot of good months. But I continue to have these little flashes of, really dumb decisions. So, well, not even just really dumb decisions, but like periods where I don't understand the market very well and I don't perform very well. So I think that I need to continue working on it before I really try increasing the amount of risk that I'm taking on and that sort of thing, right? Yeah, all the kinks worked out. Maybe one of the kinks should just be that we just don't trade that Federal Reserve stuff. I guess with the way that it played out, it wasn't like there was a moment and then all we knew that it was going, it was kind of like a slow slip. Oh, this must be stop orders, just kind of hoping that flow could flip around. And how much was it? How much in cumulative delta was it? Let's say 75 to 115. So that's like 40,000 contracts, man. Wow. And how did I let that flow come way too much of that flow come against me. Yeah, way too much of that flow come against me. Maybe something that might help me in that situation is having the power bar out, I would want let's see here, hold on a second. Pull up the settings. I want the trades power meter. No, maybe that's not the way that I want to do it. Maybe I want to use this power meter instead. Because these are ones you can do the time frame, right? Short-term power meter, long-term power meter. $300 seconds. Sure. Yeah. Then when I'm starting to see an imbalance over the last 5 minutes too far over, that should be a clear signal for me to get out, because it can be hard when you're watching the numbers flash by to know how much of an imbalance it really has been. Almost there to the close, still 2 minutes.
Just as we're approaching the US cash equity market close now, as a reminder, at 4:05 p.m. Eastern Time to get Meta reporting Q4 2022 earnings. So their estimated earnings per share is $2.26, with an estimated revenue of $31.65 billion.
I wonder also how much, 0 days to expiration options are playing here. Yeah. That's another big factor we've had recently. Tomorrow's going to be awfully interesting, won't it? I'm kind of sitting here like reaching for new things to say, but I think that I just kind of have to sit in it now and feel dumb. Like I said when I got out of that one, I was like, I feel so stupid right now, right? Because I knew that it was like, I shouldn't be holding on to this. Well, I don't know why I'm doing this. I'm having a hard time getting an exit, but oh man, when it moved, it did so quickly, and yeah. But I felt dumb because I knew I really shouldn't have been in it. I really shouldn't have been in it. And sure, there was a point where it could have reversed, but I was making the same mistake, right? It was too speculative of a trade. I had myself all prepared for a scenario, and I was trying to force it to happen.
According to FERC, Freeport LNG is allowed to expand its restart activities.
I don't know. Sometimes that kind of a setup can be some. I mean, if I had been right, and Powell, well, there's the close.
Time now at 4:05 p.m. Eastern Time.
If it had played out the way that I wanted it to, and Powell had been hawkish, then I would be sitting.
26 cents.
I'd be sitting on a huge stack right now, right?
$1.65 billion.
Might have been able to take those trades and turn them around and doubled up on them and stuff, and I could have made a ton. Was that about where did we start out at? Like overall on the day, it's been 100 ticks, more than 100 ticks. That's true. It's $1 per tick. So if I had played my cards right, I could maybe be up 150. I don't know. I might have been more conservative if it had gone my way. You know, and the thing was, the first trade wasn't a disaster. I mean, I had gotten 7 ticks favorable at one point. Right? It wasn't a disaster until things really started moving. What was the huge run up? I think that the Powell just ended up being less hawkish than anticipated, and shorts were forced to cover. I think there was a lot of people going short into this meeting. Yeah, I mean, I was kind of overall feeling short. Guess I'm never short on like my stock portfolio, but I really want to know here. Okay, so now that the market is closed, let's see what we got.
And the regulator FERC as they approve Freeport LNG's request to start commissioning one of its.
Why is Berkshire Hathaway down today? That's odd to me. And Goldman is not up either. Are there some shifts in the underlying market that we're not aware of here that maybe matter? How come it's not showing me? Oh, maybe it's not listed in. Oh, maybe it's listed in Canada. Yeah, what's up with Berkshire? Oh, they might list it different ways. On my Fidelity, it just says, oh, there is BRQW. Yeah. But why didn't that one show up before? Well, something's not right. 310.71. Like my chart is showing a blue candle. My chart is showing a blue candle, but my portfolio says that that position was a loser today. That it lost 0.27% and that Goldman lost 0.03. So let's just do Goldman. Okay. I guess maybe it's from the previous day.
So we're shortly expecting a Meta's Q4 2022 earnings. Should just be under.
I guess if we closed here and if we were going from the previous day's close, then I guess it's break even. Two very interesting. I mean, the chart is starting to get interesting in Goldman overall, isn't it? I don't know what that means, but yeah, I don't know either. It I mean, it's Berkshire Hathaway Class B shares, but it doesn't do it BRK.B on Fidelity. Oh, so if you're searching for the quotes, you do BRK/B. That's interesting.
We're seeing Meta earnings coming through now. So their revenue at $32.17 billion, which is a miss on estimate, sorry, a beat on estimate of $31.65 billion. The ad revenue at $31.65 billion,
okay.
which is a beat on estimate of $30.86 billion. EPS of $1.76. So that is a miss on their estimated EPS of $2.26 there. Again, that's Meta to get META missing on EPS.
I think one of the things is that, like,
revenue.
Because we saw such a big move, that your initial instinct is going to be pull back tomorrow, right?
2.96
but
billion, sorry.
Especially in the bond market, you might continue to see flows all come in long.
Operating loss at 4.28.
So I'm not entirely sure how to play it tactically from here.
$4 billion, which is a big.
I feel like that this scenario
$1 billion
kind of provides less opportunity for us going forward, but you know, we get the news on Thursday and Friday, and that could provide opportunities instead. So I feel like, oh yeah, did the camera die? Camera dies with me not looking so good about myself.
Quarter revenue at 26 to 28.
I feel like I need to do something. You know what I mean?
The range is within the prior estimate of 27.
This is that thing. It's like, sorry, the news squawk is talking over me. You know, you want the dopamine hit or whatever. And so you feel like there's some work that I should, and I always would make it up by doing some work, you know? I feel like there's some work I should be doing to improve my trading. But I don't know. I'm starting to feel like I'm to a point where it's like there's, you know, each little step forward that you get, it's like diminishing returns, you know? It's really hard to move the needle. Well, it's okay. I think that I concern myself a lot with how well I'm trading, but you know, it's not the only thing. It's not the only thing, right? There's always tomorrow. So I will see you guys then. In the meantime, stay excellent, team.